Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Colin Melvin. Colin is CEO of Hermes Equities Ownership Services. One of the big changes we've seen when it comes to the shareholder dynamic is government inserting itself into businesses, certainly in the banks and the auto industry as well. And in a lot of those cases, shareholders have come out on the bottom. How has government involvement affected shareholder activism?
Well, it gives us another party to work with, if you like. A key part of the work we do is finding other shareholders to get on side with, to influence other shareholders and work with them to get change, which is good for the long-term investor, which is our clients or our pension funds. So that's very different. The fact that we've got large block shareholders, governments within the UK and the US is unusual. We find this in other parts of the world, and that's far more common. Another unusual feature and something different within the market is the fact you have the regulator, government, who's also a shareholder, and the different roles between regulator and shareholder are not entirely well defined, and we have to be very careful, I think, that the market isn't overstepped and that these are kept separate.
Do you think we are in an environment where stakeholders will move to the top of the hierarchy above secured creditors or investors?
I don't think so. Stakeholder can cover a whole variety of different people, obviously, and I don't see the capitalist system being under threat in any material way. However, I do think if we're going to get it working properly again, we need to get the end owners, the pension funds, properly involved and engaging directly with companies and working together in that way. The banks that we've seen that have failed all had shareholders, and we were the shareholders through our pension plans and insurance products.
We certainly saw big shareholder groups, pension funds get involved in Bank of America in their recent shareholder meeting, leading proxy fights and so forth. And that is kind of the most visible engagement that you see of large shareholders. But are there more subtle levels of engagement that large institutional investors should be engaged in?
Well, there are indeed, and that's the work that I do. It would be wrong to suppose, though, that the action that you're seeing at the moment is somehow a success, that the levels of activism have risen. But of course, the problem is that it's rather like the stable door shutting after the horse has bolted. You know, it's too late for much of the work that's being done at the moment, and these conversations should have been had 3-4 years ago, and we were doing that at Hermes. But unfortunately, the whole of the city and Wall Street was pushing companies in the other direction.
Had big institutional investors been more engaged in financial institution, the management of those groups earlier on, could it have prevented the pain that we've been through in the last 2 years?
This is a systemic problem. It could have prevented some of the pain. I do believe that. But there is a systemic or endemic short-termism within the investment industry, which is a big part of this. So it's not sufficient. It wouldn't have been sufficient for the end shareholder to have been engaged. They would have had to have set longer-term mandates for the money that was being managed, for example. Also, of course, there were macroeconomic factors here and regulatory factors. And so it's a mix of different issues and problems. That said, I do believe that we wouldn't be in such a mess now if the long-term shareholders had been more involved.
Colin Melvin with Hermes Equity Ownership Services. Thanks for coming in.
Thanks very much.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.